Hey guys, Akil here. Welcome back to part 2 of the Building a Forex Strategy series presentation. I don't really know what to call this, but thank you guys for joining. If you are brand new to me, my name is Akil Stokes. I'm a former struggling trader for a very long time, turned consistently profitable trader, money manager, trading coach, and I'm also one of the co-founders of Tier1Trading.com. And this is the second part of a series where essentially what I'm doing is I'm vlogging my way and walking you guys through the process of developing a strategy. So if you haven't seen the first one already, make sure you check that out first, as that's going to kind of set up what you're going to hear in this one. But in the first part of this series, we talked about kind of what goes into developing a strategy, and I showed you guys the baseline test. The baseline test was testing the initial hypothesis of, kind of my theory, seeing if it worked with very little altercation. So not testing out different entries, different exits, kind of the stuff that we add on later, just kind of the bare minimum. Does my idea on what the market should do if this happens, does that work? And I showed you guys the curve. I also told you guys that I tried a bunch more times earlier in the winter and failed and failed and failed and failed and failed. And then I finally came across something that worked. However, it didn't work in the way initially, and I didn't expect it to, but it didn't work in the way in which I wanted it to. The end result was good, but somewhere in the middle, as you guys should be seeing right now, if I edit this correctly, somewhere in the middle was a massive drawdown where essentially all of the gains from the first, I think like 80 trades were given back, and it took me all the way to break even before going on a massive heater later. And although many traders look at the end result saying, just the end number saying, oh, that end number was awesome, you got to look at the process that it takes to get there, because unfortunately, many traders, there's a very high failure rate in trading. 90+% of traders fail or kind of just break even and exist in mediocrity or whatever like that. But what a lot of traders do, and this is why a lot of traders fail, they don't look at the big picture. They look at the small picture. Maybe they look at the end result and saying, this system worked perfectly. But they don't see kind of the big give back in the middle. And in real life, during that give back in the middle, that's when a lot of traders blow their accounts. So they may start off good, they may start off hot, they may do some dumb stuff like increase their position size, not buy strategies just because they want to make more money. And then they hit that drawdown, they blow everything, and they never make it to the fact or to the point where their strategy starts producing massive profits. So that's something, not that I'm I'm not in a situation where I would do that, but I don't want to give back whatever 80 trades worth of gains all the way to break even. That's just not smart. So the system did show promise, but it didn't work the way I wanted it to, which wasn't a bad thing because I kind of knew exactly what I needed to test in order to get it working. And I thought I knew, I should say. Because what you're going to see here is I tested a few different qualifiers and filters, and none of them really worked well until the very last one, which I actually did by mistake. And I'll explain that in a little bit. But first and foremost, so a qualifier and a filter is basically another test that the market has to pass for you to enter the trade. I'm trying to say this in the most simplest form possible. We always talk about on the platform, look for your reason for entry, right? There's one thing to have a good trading opportunity. So an opportunity where you predict the market is going to go bullish, but you have to wait for your reason for entry in order to execute it, right? Again, the many battles about this, we talk about, I always say you want to be predictive in your predictive in your analysis, reactive in your results. And that means that you're predicting if this happens, right, then the market should do this. And this is based off of historical data and, your knowledge and experience and intuition on what the market should do when this specific occurrence occurs. However, you're not just automatically taking the trade right there and then. You're waiting for confirmation. That's when I say reactive in your result, in your execution. You're reacting to something that the market has shown you, which should give you the probability that your prediction is more likely to be right than not be right. And that's something that we call, you can add filters to it. Basically, you're adding things. It could be an entry reason. It could be an indicator. It could be who knows what. You're adding something that provides you confirmation, an extra clue that the market is likely to do what you anticipate. And the idea of that is to get rid of some of those losses, right? Because you're going to have some losses where that filter, that qualifier never takes place. And therefore, without a qualifier, you're in the trade, you take the loss. With the qualifier, it kind of filters out some of those losses, and you never end up being involved in the trade. Now, there are pros and cons to doing this, and this is from my experience, a personal experience, obviously, but it's also with my experience working with too many traders over the last, 10 years or so. Many people assume filters and qualifiers are just positives, meaning the more I add, the better results I will have, right? Akil, I can get, addition by subtraction. The easiest way to gain more profit is to eliminate those losses. And that is true to a certain extent. But understand, this filter that you put in, it's not just going to filter out losses, only losses, unless it's super amazing. It's also going to filter out winners. So you want to find that balance where, yes, you're filtering out those losses, but you're not necessarily sabotaging your winners as well. And that was kind of the issue that I had when I went through the first three. So I did 3 initial filters and qualifiers. I thought I had a good idea on what I wanted to do just based on the observations that I made during the 11 years of initial backtesting. And again, that was just the eye test. However, when I put it to test, I didn't get the result that I expected. It was kind of an emotional, and not that I got too excited about it, because I don't get excited at all. I just shared some results on social media from, we're going to talk about it in part 3 of this series, and people are getting excited to say, "Oh, this is going to be awesome, Akil." I said, I don't know. Too early to tell. I'm kind of a pessimist in that perspective, mainly because I know how strategy development goes. I know kind of the emotional pulls of you get really, really excited and then it fails, and I just always assume it's not going to work. But anyway, as I digress, I thought I knew what I was doing with the filters, and they really didn't give me the benefits that I wanted. Now, before I show you a chart with these numbers, I want to talk about something else, right? And I'm all over the place because this is unscripted, so just bear with me if you're new. This is how I am. I don't rehearse this stuff. I just get on the microphone and spew. But in the first, in part 1 of this series, I talked about the benefits of manual testing. Manual back testing, meaning going through the charts bar by bar. If you're on TradingView, you can use bar tick replay. It makes life a lot easier. Looking for opportunities that meet whatever you're testing. And the negative of that is that it takes so long, right? You're literally clicking through bar by bar. Your finger starts to jam up and cramp. And it takes forever to acquire a lot of data, where if you just ran it through a machine, boom, it'll spit it out to you right away. However, the benefit of doing that, and this is what you're not going to get by kind of the automatic backtesting, is you don't get those observations. And again, those observations are so important. Those are the learning experiences. For me, it's like being in an internship, essentially, where I'm watching what's going on in the office building, and I'm learning. I'm picking up on key things that are going to benefit me later. That's what you get through manual testing, and you don't get that through automatic back testing. I'm sure you can kind of schedule to look for certain things, but you don't get that kind of that hands-on approach to it, which I think is valuable, especially for trading psychology. You see kind of the ups and downs and how you would emotionally deal with it. But one of the negatives of manual backtesting is that it is manual, and human error is a big thing. If you've ever backtested, like I said, not only does the hand get tired, but if you don't take crucial breaks, the eyes get a little bit lazy as well. Whether it's just looking at something on the charts or recording it in an Excel spreadsheet. And what I noticed as I was going through the previous test is that I made some errors, right? There were some losses that I forgot to put the minus in front of. There was some wins that I forgot to enter the profit, right? So I actually was able to find a few errors that I made, which reduced the results from that first test. So I think at the first test, the magic number, the total pips was, gosh, help me out here. Was it like 10,000, 9,000, something like that? It actually went down to about 7,000. Not that those pip matters, but it's important to have that because this is the baseline test. This is what you're comparing everything off of. So in front of you is the chart of the baseline test. You should be looking at trades, wins, losses, win percentage, profit, average win, average loss, average trade, average profit. Again, these aren't necessarily all important numbers, but trying to make these videos as simple as possible for the newer type of trader. We'll do the complicated stuff on the platform later. But you can see in qualifier number 1, well, first and foremost, you'll notice that it reduced a massive amount of the trades, right? Originally in the baseline test, there were about 235 trades, right? Qualifier number 1 took it down to about 74. Whew. What's that? Splitting it into thirds, basically. 2/3 of the trades I took were gone, were filtered out. However, if you look at wins and losses, it didn't really make too much of a difference. It filtered out a lot of trades, but it filtered out just as many wins as in losses, as the win percentage only went from 41% to 43%. And you can look at the profit and whatnot as well. The average win was up. The average loss was also up. The average trade was up. But because the frequency was lower, it actually didn't produce as much as the baseline test. So let me ask you guys this question, right? I know a lot of you guys are caught up on win percentage. Win percentage is better. Much less losses, almost 100 less losses. But is this beneficial? Does it make the performance better? The real number you're looking for is expectancy, but again, we're not gonna talk about that here because that's gonna confuse a lot of people, I think. But did this make the system better? No. So I went on to test number 2. I was going to test all 3 anyway, but I went on to test number 2. So, okay, maybe that'll make a difference. So qualifier number 2, okay, didn't cut out as many trades, right? 235 for the baseline, 74 for qualifier number 1, back up to 130 for qualifier number 2. Okay, that's good. We keep a lot more wins. In comparison to qualifier number 1, you can see we have 56 wins versus 32 wins. So a lot of those wins came back. However, what also came back? A lot of those losses. And the win percentage was exactly the same. Now, it did filter out a few more losses. You can see that the average win was up to 330. The average loss was back down to kind of what the normal was. Average trade was 46. So it did perform a little bit better. But again, is this anything that's going to get you excited? No, because again, it underperformed the baseline test, meaning that the initial test of what I'm doing performed better before I added anything. And then I tried number 3. I kind of knew this one wasn't going to work, but I did it anyway. This was kind of like a double qualifier, combining qualifier number 1 and qualifier number 2. And that chopped everything down to about 31 trades total. 13 wins, 18 losses. Win percentage still didn't change. Didn't really do anything to help the system. Basically, it was a waste of time, but I was curious about it, and now I know for sure that it doesn't make a difference. So if you look at these 3 initial tests, right, was I helping or hurting the performance of the baseline of the system, the hypothesis, by adding filters and qualifiers? Well, I was hurting it. Win percentage didn't change. Again, the key thing that I was looking for was to filter out some of those losses. Win percentage didn't change at all. So although I filtered out some of those losses, I filtered out just as much wins, essentially. And the pippage went down because of the frequency of the trades being taken. So by adding these qualifiers, I actually sabotaged my system. And, it's not a big deal here when you're testing it, but the problem is that many traders will do this without testing it. They will assume that, I'm going to add this and this and that, and I'm going to make everything better, and they never test it. And before you know it, they make something worse. Remember what I mentioned in part 1 of the series where I talked about many traders think developing a strategy is as simple as finding an awesome YouTuber and strictly copying whatever they're doing. And then I said what many of you guys are going to even do is you're not just going to find a YouTuber or someone out there on the internet land or in a book with a great system, but you're then going to take that great system, you're then going to try and add something else to it, and then you're going to break it. You're going to make it worse, right? This is a perfect example of that. For someone that, let's say I was presenting you with the baseline system. I said, hey guys, super awesome system. Trade it this way. Don't do anything else. And then you get it and you say, I'm going to add this and that because I'm going to make it better. And you never test it because that's what rookie traders do. And then you complain to me about how it's not performing well when you actually took something that performed pretty decently and you made it worse. And I bring it up because that is a real thing. I remember a long time ago with the previous company I used to work with, there was a mechanical system. Matter of fact, I traded one of these mechanical systems. There's a mechanical system that came out, and it was as simple as when the market gives you a green arrow, do this. When the market gives you a red arrow, do that. Right? Don't change anything. It's optimized. Just follow the rules. And we still had traders email us, hey, the system is broken, it's not working. And we got to, we talked to them, customer service, well, what did you do? Well, I added this. And why'd you add that? Well, because I wanted to add something to take away some of those losses. Okay, well, did it take away some of those losses, sir? Yeah. How many wins did it take away? Well, it took away even more wins. You should probably just trade it the way it was originally tested. So, long story short, excuse me, I'm going to cough real quick. All right, thank you. So long story short, I went through this entire process of going through all the data again, testing it 3 different ways, anticipating that I was going to make it better. Super excited about that fact, even though pessimistic on the inside. And all I did was make it worse. So scrapped that idea and I went back to kind of the basics. And what I did was I actually went on to what I'm going to talk about in part 3 of this series. Instead of worrying about entries, right? Because these are qualifiers for entries. I decided to kind of change up what I was doing and focus on the next part of my journey, which was exits for targets, right? There's 3 things in trading. There's entries, stops, and targets. Those are the 3 things we always focus on. Entries, stops, and targets. I kind of look for qualifiers and different ways to tweak all 3 of those areas. And if you can do so, you're pretty much in a good spot. So I was failing on entries, so I decided to take a break. You guys know me. I like approaching things with a clear mind. I said, let's work on the next process. Let's play around with a few ideas I had on targets, on targets and exits. And as I was going through that process, right, again, this is the value of manual backtesting. As I was going through that process, I actually found something that I thought would work well for exits that didn't really work well for exits. But I noticed that, hey, this was actually a pretty good qualifier for entries. So after doing all that work, I went back and I tested what had failed on exits, excuse me. And I went back and I retested it for entries. I was like, this might work. It's worth a try. Again, I'm a big fan of testing everything just so you don't have those lingering questions in your head. And I went back and I tested it. And here are the results, right? So the trades went down to about 110. So it reduced the trades by a little bit more than half. The wins 52, losses 58, but the win percentage went up to 47. So it went up about 6 percentage points. However, what's more importantly than that, because again, as long as we're above 40, I'm personally okay. I'd rather be like 50 and 60. I like to win more than I lose, trust me. But as long as I'm not under 40, I don't have those cracks in the arm or the cracks in the dam like I showed in part 1 of the series. So 47% is fine. But more importantly is P&L, right? And I looked at the P&L and again, I want to ask myself, what is it doing to my overall trades? And well, the average win, it took it up from the baseline test, although it took it down, I guess, technically from the test where I combined both of them. But it also reduced the average loss a little bit. And the average trade, as you can see, was a lot higher. And most importantly, the total profit was higher, not only than testing both, not only than testing qualifier 1 and qualifier 2, but also the initial baseline test. So although I chopped the frequency down, I was able to produce more profit. So I was a little bit more efficient in my trading. So I don't know if this is going to stay here. But it's something I'm certainly going to look into, and I'm going to test. I'm going to test this compared to the baseline and everything I test moving forward. I'm going to go back and do some of the other tests I did with exits as well, using this new criteria and just see how it works. But it's more proof that, again, a great trading buddy of mine said, trading is a journey of self-discovery. And meaning that it's you learn a lot about yourself during trading, but you also learn a lot about the markets. And again, what I may have stumbled on as far as the qualifier that I want to use for my entry, I didn't plan on that initially. Just like this whole entire system, I didn't plan on it initially. It just came up through observation, me paying attention while I'm testing, writing stuff down, taking notes, saying, I wonder what that would look like. And then testing it and or either, nah, it doesn't work, like the three things I thought would work, or saying, we might be onto something. And that's the most important message that I can give you guys as traders. Don't be in a rush through this process. Don't go through this process simply looking for answers, right? Even if testing isn't going well, I still personally think it's worth completing just to see what else you may find, because you may stumble on something that works great that could be used for later, or can be used in a different system, or can be used with something that you already have. You just never know. So it's always worth going through that journey, in my opinion. So I'm at part 2 right now, or I actually did part 3. I'll record that in a little bit, but just to sum everything up, part 1 was the baseline test, the initial hypothesis of what I want to do in the market. It did pass that test, seeing that the equity curve looked well. The equity curve ended where I want it to be, but it did need some tweaks in the middle. So after passing that initial test, I went to try to add qualifiers in order to clean up some of the junk in the middle. And again, after failing 3 times on what I thought would work, I went on to really go to part 3, which is worrying about exits. While I was testing and having some pretty good success with part 3, I stumbled across something that I thought would be interesting to test for part 2. So I went back, tested it for part 2, and it actually did end up kind of cleaning up the mess in the middle. And you should be able to see that with the comparison of equity curves in front of you. So now it's going back to part 3. I want to test part 3 in a few different ways, right? Part 3 is exits. For targets, I want to test it on the initial baseline, because I actually had some really good success trading it with no filters for entry, but just making some adjustments with target taking. And I want to compare that to how those same adjustments would unfold with the new qualifier that I added. So that'll be pretty cool to see the comparison. And then part 4, right? I'm getting really, really ahead of myself right now. But part 4, we're probably going to take a look at exit techniques. I got to test this still, but I've also stumbled across really a different way that I may want to exit. It's funny. The exit is what I was pretty confident about how I wanted to exit, because during the initial baseline testing, it worked really, really, really well. And again, while I was testing different reasons for entry, something that failed with the entry techniques, I noticed may actually be good for exits, for a kind of maybe not a trailing stop, but a signal of when to get out of the trade, because it's going to go against you. And that may be, again, I got to test it. I have no idea if it works or not, just off the eye test. That may be very beneficial for trailing stops a little bit tighter, which means I give back less as the market goes against me, and B, getting myself out of losing trades quicker. So again, reducing not necessarily how much I lose as far as the total number, but how much pip-wise I lose when I lose. And that could be big if I can drop that by, a few percentage points. So I'm excited about that, but I guess we don't want to get too ahead of ourselves and just be focused on part 2, adding qualifiers. So again, do me a big favor. If you like this video, hit that like button. That's big for me. Also share this on social media. Leave me a comment or a question underneath as well. I apologize for this one not being as clear, but it's New Year's Eve. I'm rushing through it because I got to host something for New Year's, and I don't feel like doing it tomorrow. But hopefully it made sense, and hopefully it continues to illustrate the process and the mindset of what I'm doing as I'm going through this testing process. For you guys that are on a tier 1 platform, I did get a question about this. They said, Akil, if this strategy does end up being successful, will you add it to the platform? Of course, we don't hide anything. We'll put everything on the platform. And hopefully, if it all works out, you'll be able to see these strategy development diaries, whatever I'm calling it, building a Forex strategy series, before I go on to explain the actual system, if it does work. And I think that'll be kind of cool to see everything that led up to it and then the final product. So I'll see you guys at part 3. Make sure you subscribe, hit that notification bell. That way you don't miss it. It should be coming soon because I've already done most of the work for it. It just comes down to me actually recording it. And yeah, I'll see you guys next time. Until then, plan your trade, trade your plan. Have a very happy New Year's, even though by the time you're seeing this, it's already New Year's. But you get what I'm saying. All right, see you next time.